So, first of all, thanks for the invitation. This presentation will take a slightly different perspective, more a macroeconomic one. I've been personally working on credit and house price cycles over the recent years, and the organizers have invited me to give a presentation on this. It happens that I've just finished a report that was conducted by the Working Group of Econometric Modeling of the ESCB, which is a substructure of the Monetary Policy Committee. So pretty unrelated, actually, to macro-potential policies. Yeah, and I try to summarize those results in seven stylized facts. Let me just, first of all, talk about, how does this work? The principles. So far, there has been not so much mention of cycles in this discussion. So what you see here in the top is just three series for the US of GDP, total credit, and house prices. Well, and one way to look at them is basically to eliminate the long-term trend and just have the cyclic component left, which is supposed to be some measure of, well, deviation from fundamentals. That's a way that macroeconomists like to look at developments. As you know, the output gap is a very important indicator for monetary policy. And while clearly it makes sense to look at credit and house prices in the same way, I might just remind you that the BIS regulations on countercyclical capital buffers refer to the cycling the credit to GDP gap. So this team that I was coordinating obtained estimates of those credit, house price, and GDP cycles in 70 countries. The purpose was to assess the properties of these cycles. We used a number of methods. I'll not go into that. Apparently, you're somehow, I mean, there's quite some difference in the way that macroeconomists and macro-potential experts view the world. We were interested in those questions here. Is there a common cycle in credit, housing, and GDP and other financial series? What are the relations between those cycles, especially what are the relations between house price, credit, and GDP cycles? What explains cross-country heterogeneity in these cycles? How synchronize the cycles across countries? What's the properties of real-time estimates? Those were somehow familiar with monetary policy know that there's quite some uncertainty in real-time estimates of the output gap, and the same applies to those cycles. And finally, can DSG models, those models that are used for the analysis of policies, can they reproduce the stylized facts that are found by the empirical methods? This is just a bit of review of the literature. So this notion or the interest in financial cycles is actually pretty young. The first papers were published by the BES and the IMF in 2012 by Borre and Dreyman for the BES and Claessens, Levin, and so on for the IMF. They use pretty basic methods. Naturally, the second generation of papers then would try out more sophisticated methods, and that was done by the Dutch National Bank, by Gabriele Galati, and I did another paper with a Dutch woman. Yeah, let's go right into the stylized facts. Fact number one, house prices and credit volumes are subject to large medium-term cycles. That's basically what was claimed by Borio and Claessens, and that's a pretty robust fact. We confirmed this. What you see here is, well, I selected the four major economies of the euro area, plus, since we're in Lithuania, two northern countries, so Finland and Denmark. And you see that they're really quite, with the exception of Germany, which is really an outlier, you find quite large cycles. In credit and house prices, well, you see that, I mean, actually, the selection here actually implies pretty large cycles. So Spain, Finland, Denmark used to have pretty large fluctuations in house prices of plus minus 30% around the trend. What you see for France and Italy, where it's a bit smaller, that's more usual. That's what you would find for the US, for instance, or Canada or so. You also see that so our estimates indicate that the average cycle length is some 14 years. Standard deviations are 7% for credit and 10% for house prices on average across those 14 countries that we considered. Clearly, you see those cycles are very closely aligned, and that relates to this feedback loop that has been mentioned today already a few times. This feedback loop between the value of housing as a collateral and the provision of mortgage. So fact number 2, medium-term cycles in GDP and housing are actually closely related, and that's rather new and a bit controversial, because the initial papers by Borio claimed that these are two rather unrelated facts. What we find is actually that fluctuations in housing are pretty closely matched by fluctuations in GDP. They are smaller, clearly. There's additional shorter fluctuations in GDP, so the average cycle of GDP cycle length is estimated with 11 years. But if you have a closer look, you will see that, for instance, in around the late 90s, you have some booms in GDP, for instance, in France and Italy, that are not shared by house prices, but the major fluctuations are actually quite closely aligned. Then, of course, we're immediately interested. The most natural question to ask now is, well, how do those cycles that we get for GDP, how do they compare to output gap estimates? And the answer is, it depends quite a lot on what kind of estimate you use. And that's shown here. So the blue line shows our own estimates from those model-based filters that we have been using. The red and yellow lines show output gap estimates from the IMF and the OECD, and this dark dashed line shows some sort of industry standard of say, the academic literature on output gaps, and that's obtained from a bandpass filter with a frequency band of 8 to 32 quarters. So in this business cycle literature, there has a consensus emerged over the last 20 years that business cycle fluctuations are somewhere in between, 2 and 8 years, so 8 to 32 quarters. And most theoretical macroeconomists, when they look at business cycles, they look at these cycles. What you see here, actually, in most cases, those house price cycles are very closely linked to output gap estimates from the OECD and IMF, and in some cases they are grossly different from the academic definition of the business cycle. Well, one corollary to this is actually the academic definition of the business cycle, and the IMF OECD output gap estimates are very different things, which should be of some interest to monetary policy, I guess. To my knowledge, this has never been really documented, somehow surprisingly. The other thing is, if you take this perspective of the OECD and IMF, it's clear that actually house price cycles and GDP cycles are, well, pretty closely related. So this means they're not really independent phenomena, as was originally claimed by Borio and the BES. And it also implies that, well, macroprudential and monetary policies perhaps should listen to each other. So, yeah, well, shall I go into that? I don't know how many of you are familiar with filtering, but I'd like to explain what's going on here. So, what Borio and Dreman did to come up with this conclusion that financial and business cycles are independent. So they extracted those cycles in credit and house prices from a filter that was targeted to extract cycles in between 8 and some 20 years, right? Whereas GDP is, as I've just explained, is targeted to take cycles from 8 to 32. Well, it's a mathematical proposition that if you proceed like this, the cycles that you get are uncorrelated. Yeah. If you take the same filter for GDP as you take for total credit and house pricing, which is the blue line here now in the lower left chart, you see, well, you get the same what I've just shown, you know, that is actually house prices and GDP are closely aligned. This, first of all, shows the high correlation here between these three cycles, and then also something on equity prices. What we did here is, for each of those 70 countries that we had under consideration, we ran a factor analysis comprising 7 series. That's GDP, house prices, loans to households, loans to non-financial corporations, equity prices, long-term rates, and the spread between long and short-term rates. And this here plots the distribution of the factor loadings. So what this shows you is that the GDP, house prices, and loans, they have all very high loadings. So they basically, again, they share common cycles. Whereas equity prices, bond yields, and spreads, well, you see that they have clearly lower loadings. They get even into negative territory. The conclusion from that is, first, GDP, credit, housing and GDP, credit, and housing are closely related, but it's not such a good idea, perhaps, to combine credit and housing with equity prices and other liquid assets into well, composite indicators of the financial cycle or of financial stress, which has been done by a few authors. So, what explains cross-country heterogeneity? This here, well, you've seen already Germany was really an outlier. There's quite some difference in the standard deviation, the volatility of cycles across countries. So we looked for determinants of these differences, and there's one pretty robust thing that has already been found in my earlier paper independently by Stefan Hube, a PhD student of Jordi Gali, and that is the volatility of house price cycles across countries is closely related to the rate of private home ownership. That is, the more people own the house they live in, the higher the volatility of house price cycles. I think the most plausible explanation for that is that if you have a high rate of private home ownership, that means that also a high share of well, middle or even lower middle income households own the house they live in, and that's precisely those households that are, well, that depend on mortgages, that are credit constrained and collateral constrained. So I think actually this relationship here is quite a strong indication that there's a close, that this leverage cycle, these collateral constraints, that they really matter for house price cycles. You also see the same thing holds for GDP cycles, and that actually indicates that this leverage mechanism is also an important determinant of the volatility of GDP cycles. This work actually here was done by a staff member of the Bank of Lithuania. I don't know whether she's here, Maria Rosaria. She did something new. She also found that the synchronicity of GDP and house price cycles is actually related to the rate of home ownership. That is, the higher the rate of home ownership, the more closely GDP and house prices are linked together. We also looked at other indicators and didn't find that much. For instance, the LTV ratio doesn't really matter. We found a bit of evidence for the interaction between the LTV caps and the share of flexible rate mortgages. So in countries where you have high LTV ratios or high LTV caps and a high share of flexible mortgages, you would find somewhat higher volatilities of cycles. So all this indicates really that I think it's actually household characteristics that matter for the volatilities of cycles, and that seems. I mean, I'm more an empirical macroeconomist, but I would conclude from that policy measures that are targeted towards household finance should be more effective in curbing cycles. Another thing we found, and that's probably related to the specific story of the euro area, is that the volatility of cycles is very much related to the current account. So countries, so countries with current account deficits, they would have higher volatility of cycles. I have to rush a bit now. Well, this shows that house price and credit cycles are less synchronized across countries than GDP and equity prices, so they're really a domestic thing, but this has been mentioned already a few times in earlier presentations. There are really lots of regional differences. Let me talk about real-time estimates, because that's really related to the question whether macroprudential policies should target house price cycles. So there's quite some literature on the output gap on this. We know that real-time estimates of cycles are pretty unreliable. With methods, statistical methods, it's like with the naked eye. No, ex post, it's easy to tell whether there was a boom or a bust. It's just really difficult in real time, and statistical methods face the same issue. There's some literature from output gap estimates. It's pretty controversial. Some studies argue that real-time output gap estimates are pretty useless for monetary policies. Others say, well, with sophisticated methods, you get better stuff. This is the same thing for house price and credit price cycles. So what you see here is some examples of comparing final and real-time estimates. We made some sort of experiment whether with parameter estimates from 2000, you would be able to have detected the boom that finally led to the financial crisis in real time. And you get very different stories across countries. You see, actually Spain or Italy would have worked pretty well. For France, well, Germany is not relevant for France, you wouldn't have seen anything really. For Spain, that's quite a typical case. So even if you have a well-behaved estimate in real-time estimate, a well-behaved model, there still would be a bias of the real-time estimate. So the real-time estimate of a cycle would tend to be 30% smaller than the final estimate. And so it's very difficult to say in real time whether this is really some excessive development that we have to target. No. But the other thing is actually that the story seems to be a bit better for house prices than for GDP cycles, and because house price cycles are much larger. We've seen before the volatility of GDP cycles is 3 to 5% of house price cycles. I'm over time already? Oh. For house price cycles, it's 10 to 20%. So we tend to conclude that it might be a bit easier. So, well, that's the end of my presentation. Just three policy implications. First, one should look at the linkages between monetary and macroprudential policies. Country-specific policies are important. It really seems that they also matter for macroeconomic imbalances in the euro area, so that's really an important issue. And, well, on the targeting house prices, I've just brought the argument. Thank you. I'm sorry.